Yo, what is going on, guys? Lottery Stocks here. The banks just came out with earnings, and we have more ahead this week. But I want to prep you for what's to come because it all correlates to our play. So I'm going to play this clip for you, and then I'm going to go over this article. Also, guys, make sure to hit the link pinned in the top of comments to download and fund Moomoo. You will get up to 10 free stocks, each valued up to $2,500. This is a powerful broker, a powerful platform where, especially if you trade options and you like to trade options constantly, they have a ton more strike prices than Webull, than Robinhood, fast execution time, decent charting, and there's a lot more. We'll go over it in another video, but it's definitely worth checking out. Let's get into the video.
Folks, there's a new 800-pound gorilla in the banking world after the Federal Reserve today approved U.S. Bancorp's acquisition of MUFG Union Bank's retail banking business. The green light for the deal gives U.S. Bancorp just under about $700 billion in assets and solidifies its status as the fifth largest retail bank in the country. Look at U.S. Bancorp, top of the S&P right now, up 3.7%. We've got Mitsubishi UFG Financial down about 1%. By the way, we've got the mixed bag of results today, as we already mentioned, from the likes of Wells, Citi, Jpmorgan, Morgan Stanley. You've got everybody higher except Morgan, now down 5%. It's been a tough session for Morgan. All right, well, Wells, all of these names, if they beat, still, it was overshadowed by the fact that just about all of them saw profits fall year over year. With more financial titans on deck to release quarterly reports next week, let's break it all down with RBC Capital Markets large cap bank analyst and U.S. Bank Equity Strategy head of banks, Gerard Cassidy. Great to see you, Gerard. Which one of these four that came out today do you like the most, and what is the problem with Morgan as you see it?
Sure. Well, thank you for having me on the show. And I think one of the big trends that we saw with all four of the big banks, Citigroup, as well as Jpmorgan Chase, we saw it with Wells Fargo and PNC and U.S. Bancorp. You didn't see it with Morgan Stanley. But the big story for the banks is the rise in short-term interest rates and the impact that's having on their net interest margins. These margins are growing very rapidly because the banks are able to reprice their assets faster than their funding costs. And it was quite striking at Wells Fargo because the mix of their deposits is geared to the consumer, whereas a Citigroup, on the other hand, has more wholesale deposits, so they didn't benefit as much on the margin expansion as somebody at Wells Fargo did. So what we have been recommending to investors is to look at the banks with the high concentration of consumer deposits, because the margin expansion for those banks will be better. And we saw that again at Wells. So in today's names, PNC is the name we'd recommend investors look at because of their high concentration of consumer deposits, but also commercial loans on the asset side of the balance sheet.
Well, I get that. And then I would think that a name like KeyBank looks pretty good if you're thinking with that logic as well.
Liz, right on. I would totally agree with you. For next week, when KeyCorp reports, very strong consumer deposits, one of the best of the regional banks, and they have one of the highest levels of commercial and industrial loans. And what we saw today from the banks was the C&I loans, as they're referred to. We saw double-digit loan growth on a year-over-year basis, in some cases over 20%. So we should expect to see KeyCorp put up very good C&I loan growth, and then they'll support that with core funding, which would help their net interest margin.
These rates are so high, and you mentioned that the margins are looking good for a lot of these banks, but it's almost as if whatever they capture from charging more from loans is being tinged a little bit in the red because people are worried we're seeing a slowdown in the economy and that high rates will slow down everything. That's the Fed's intention, actually. But Jamie Dimon's over at Jpmorgan had said we're still on the path for an economic hurricane and a recession. How do you play those names knowing that that is the possibility?
You put your finger right on it. There are some real cross currents for the bank stocks. You have the strong benefit, of course, of these higher rates, but offsetting some of that benefit, of course, is the expectation that credit will deteriorate. And that was the interesting part about today's results. All of the banks reported very strong credit. The net charge-offs, which are credit losses, in most cases were down or flat. The actual delinquent loans or non-performing assets, as they're referred to, they were flat to down. So no one showed any evidence of deterioration. Now, what has happened, though, is the banks under the new accounting rules called CECL, current expected credit loss accounting, which went into effect in early 2020, the banks have to now start building up these reserves for loan losses if we go into a recession next year. And we saw that today. But what it was more interesting was the growth in revenue more than offset the buildup of these reserves. But you're bringing up a good point. There's a real concern amongst investors that next year, if we see unemployment around 5 or 6% and negative GDP growth sometime next year, it's going to be more challenging on credit. That being said, though, the banks are going to still be able to maintain this revenue strength because we don't expect rates to be cut at all in next year by the Fed, and that will maintain those margins.
We are on deck for a lot of bank earnings next week. Gerard, thanks for setting us up ahead of that. We appreciate it.
So that is right. Bank earnings, Jpmorgan, Wells Fargo, and Morgan Stanley lead reports just came out. Performance for the period were mixed despite big increases in interest revenue. Capital markets did not improve in Q3 and show no sign of improvement ahead, significantly reducing investment banking. Loan volume will weaken into a 2023 recession. Banks are facing greater liquidity constraints and are having to fund loan growth with higher cost deposits, debt, and securities portfolio runoffs, Morgan Stanley analyst Betsy Graysick noted last week. Rapidly rising interest rates and higher capital requirements are leading to an accelerated upturn in the credit cycle, heading into a period when loans are more costly and difficult to obtain. That puts financial institutions with excess capital, liquidity, and positive operating leverage in the best position long term, he says. And Leon also predicts fourth quarter consensus estimates and 2023 outlooks will lower further. Equity analysts are likely to reduce target prices and EPS estimates as optimism about future bank performance declines. He mentions sluggish banking activity, which is driven by high inflation. And we know that the Fed is not quite ready to drop that inflation rate. Wells Fargo adjusted earnings were sliding 3.5% to $1.13 a share on a slight revenue drop of $18.77 billion. Wells Fargo quarterly earnings fell 27% to 85 cents per share, but revenue rose to 3.7% to $19.5 billion. The company said its net interest income spiked 36% due to higher interest rate loan balances and lower mortgage-backed securities automation, while non-interest income fell 25% on declines in mortgage banking, venture capital, and investment banking income. Wells Fargo noted $2 billion in operating loss related to litigation, customer remediation, and regulatory matters. Wells Fargo rose about 1.9% on Friday after climbing more than 4.6% on Thursday, but shares have fallen 15.5% this year. Now on to Jpmorgan Chase earnings. Expectations were for their earnings to drop 22% to $2.90 a share, while revenue climbing to 8.4% at $32.13 billion. The results, however, earnings fell 16.6% to $3.12 a share, and revenue was up 10.3% to $32.7 billion. Jpmorgan added $808 million to its credit reserves during the quarter, driving lower net income compared to last year when it released $2.1 billion from its coffers. Net interest income was up 34% thanks to higher interest rates, but non-interest revenue fell 8% on lower investment banking fees, losses in corporate securities investments, and lower production in home lending. Jpmorgan closed up 1.7% on Friday after gaining 5.6% on Thursday, but it is also down nearly 35% year to date. So you guys can see that whatever they throw out at us and whatever they try to cover up, take a look at the trend line on each of these charts. All this is doing is popping up, hitting that trend line again, and it's going to come right back down. On to Morgan Stanley. Wall Street's forecasts were a 25.5% drop in earnings to $1.52 a share and a 10% revenue decline to $13.27 billion. The results were adjusted earnings fell 25% to $1.53 per share, while revenue dropped 12% to $12.98 billion. Morgan Stanley's investment banking revenue and investment management revenue tumbled 55% and 20% respectively as capital markets action slowed. Morgan Stanley fell more than 5% Friday during trading, reversing its 3.6% growth from Thursday. Morgan Stanley shares are down about 22% in 2022. Again, this trend line tap is coming again. Nothing new. Citigroup, the same bank that defaulted in 08, the same bank that the Fed illegally bailed out, their adjusted earnings were seen tumbling 33% to $1.44 a share on a 6.5% increase in revenue to $18.27 billion. However, their earnings fell 24% to $1.63 per share, while revenue grew 7.8% to $18.5 billion. Citi's profit decline was driven by increases in its loan reserves. Citi set aside an additional $370 million for credit losses during the quarter, bringing the total to $1.37 billion last year. It released more than $1 billion. Meanwhile, Citi's personal banking revenue rose 10% to $4.33 billion. Same exact trend line, the decline in banks and their share price. Now, there's no need to go over the last bank, PNC. It's on the same exact falling channel. Until the market rebounds, they're just going to take a larger hit. Each one of these counteracts each other, which is going to lead to a huge drop. Right? You have government bonds, you have earnings season. They come together, stocks are going to be the ones to fall. Bonds don't have that risk attached. So you can take a look at these bank earnings season. Okay, well, banks are doing somewhat well, right? Half of them were slightly green, up 1%, up 2%, up 3%. However, all of these banks are down over 20% year to date. And we have more banks posting earnings this upcoming week, so make sure to get ready for that. As I have been seeing a lot of reports that banks are having liquidity issues across the board, which ultimately will affect their loans, which ultimately will affect institutions, which ultimately will affect their positions, their collateral, their margin requirements, which you guys have saw in the clip that I just played for you. They talked about the rising in margin requirements. That is what I got for today, guys. Tune in case I drop another video. I love you all. Lottery Stocks out.